Don't pay off your house. Keep money more liquid and safer than tied up in a house. In this episode, I'm going to answer the question, what should a widow do with life insurance proceeds? You may be surprised with the advice I'm going to give, but I have met with thousands of widows and widowers, and they have thanked me for what I'm about to teach you. So I'm Doug Andrew, and I have helped thousands of people protect themselves and prepare for a comfortable retirement now for more than 4.5 decades. And many of these people, because of whatever reasons, they think they're going to live to age 90, 95, or 100, but you wouldn't believe how many retirees within 1 or 2 years, one of the spouses passes away. In fact, I have books and articles about how to increase your LE, life expectancy. But the sad fact is, when people pass away and they have life insurance on their life, oftentimes the widow, and sometimes the widower, they're given advice that is so horrible. Most family members, well-intending, most friends say, oh, you're getting $500,000 from a life insurance policy. Well, pay off that mortgage on your house. Hurry and pay off that mortgage. You owe $250,000 on the house. And I go, oh, that, in my opinion, can oftentimes be the worst advice. So I don't want you to make any mistakes. I want you to be aware. If you're watching this episode, it's probably because you're thinking, someone you know that's close, maybe you have just lost a spouse, and you have this lump sum of tax-free money from a life insurance policy, and you think, golly, well, maybe I ought to just pay off all my debts and mortgages on my house, and then I won't have a payment. Think twice. So let me share with you first some of the great benefits, what I call the beauty of life insurance. When a death occurs, of course, it's a sad way to access money out of an insurance policy, because in my various books that I've written, I talk about 3 ways to access money out of a life insurance policy: the sad way, the dumb way, and the smart way. Most people come to me not necessarily wanting or needing more life insurance. What they want is a safe place to accumulate their money at predictable rates of return. And when they want the least tax impact, I say, why don't you just choose tax-free? And that is accomplished in an insurance policy where you maximum fund it. You take the least amount of insurance the IRS will let you get away with, and you put in the most money the IRS allows. And people go, whoa, I've never heard of that before. I always thought insurance was a poor investment. Well, you haven't seen how you can use it for living benefits. But in this episode, I'm talking about what if death occurs. So it's sad, but golly, what are the benefits when you get a lump sum of $500,000, $1 million, $10 million of life insurance proceeds? Do you know the 2 biggest benefits? Number 1, life insurance proceeds are totally income tax free. You do not have to pay tax on those. So where should you put it? Somewhere where it's going to continue to be tax free. I go, hello? And yet people go, where's that? They're shocked when I teach them. Number 2, life insurance proceeds are not subject to the claims of the creditors of the deceased. In other words, if your spouse passed away and had some debts or creditors, you may choose to pay them off, but you don't have to legally. You do not have to take life insurance proceeds and pay off the debts of the deceased unless they pledged that life insurance or named the creditor as a beneficiary or assigned it as collateral to borrow on a loan. That's the beauty of life insurance. So what should we be doing since life insurance has some benefits, and what would be far better than just paying off a bunch of debt when widows are going to need to establish credit in their own name? So, first of all, my advice to widows is if you've got a lump sum of money that is totally tax-free, keep it tax-free. Well, how do you do that? Because most of the time they think, well, I'm going to pay off these debts, maybe the mortgage, and take anything that's left over and put it in the bank or somewhere, and they just think you got to pay tax on the interest or dividends in most investments. Well, it's because they're not aware of the very vehicle that created the lump sum tax-free transfer called a death benefit under Section 101A of the Internal Revenue Code also allows you to earn interest tax-free and take tax-free income inside of a life insurance policy. Most people think of life insurance as a death benefit, but actually it is more powerful when used as a living benefit. Many times what I'll tell a widow, okay, you've got $500,000, you got $1 million of tax-free money, keep it tax-free. Turn around and let's put that back into a new life insurance policy on who? You. If the widow is insurable, okay, and many times we insure widows up to age 80, even if they're not in the best of health, and they're able to put $500,000 or $1 million in, and I fund it over a 5-year period to comply with the Internal Revenue Code. It's called the TAMRA tax citation. But what happens is if they put $1 million in there, they usually will earn average rates of return like I have for the last 45 years, between 6 to 10%. $1 million can generate $60,000 a year of income tax-free. That would be like getting $80,000 or $90,000 taxable income out of some other investment. So why would you put money into a taxable investment where you have to have 50% more return to have the same net spendable income? They go, well, I've never seen an insurance policy that does that. Well, then you haven't seen one structured correctly. Because I have helped thousands of people be able to put in lump sums wherever it comes from. But if you're getting a tax-free proceed, whoa, keep it tax-free. Put it into a new life insurance policy, and then enjoy tax-free accumulation and tax-free income. $1 million can generate $60,000. Many widows take out $80,000 a year, and they go, well, I don't need that much. Well, then don't take out that much. But it knocks the socks off of most places where they would want to put their money, and it's liquid if they need to access a lump sum. It's safe. If the markets take a dive, they don't lose by using indexing, and it's totally tax-free. And so this is probably the best advice that I've ever given, and they send me thank you notes, and they come in year after year and say, whoa, I never dreamed I could continue to enjoy tax-free income without depleting principal the rest of my life. And then when they pass away, it blossoms again and transfers to their children totally income tax free. Hello? Are you beginning to get it? So when a widow receives an insurance proceed, as I've said so many times, people well-intending tell them, oh, hurry and pay off your house. I don't think that's generally wise to do because this is the opportunity to establish credit in your name. So many times widows were with their husband, let's say, on a tax return, but the husband maybe was the primary breadwinner and established the credit on the mortgage. If you go in and you just pay off the mortgage and then 2 or 3 years later you need to access money or borrow money because you want to start a business or loan your children money, whatever it is, you then have to go, I need to go borrow money. So you go into the lender and they're not going to loan you money unless you have the ability to repay. And you may say, well, I have Social Security, I have this, I'm earning some money or whatever. But they go, well, where's your track record? Well, I should have excellent credit because I haven't used credit since my husband died. Well, hello, they don't give you credit unless you prove that you can repay. And see, this is your opportunity to not have to requalify for a mortgage. Keep the mortgage and take the interest that you're earning off of the lump sum that you were going to use to pay off the mortgage and put it over into what I would recommend, my favorite vehicle, the Laser Fund. Why? Because the Laser Fund is tax-free and it has historically earned between 6 to 10%. Let's just say 8%. You're earning 8% interest compounding tax-free. So let's say $1 million of life insurance proceeds goes into a new insurance contract earning 8%. That's $80,000 a year. Let's say the mortgage, is costing you a net after tax of $40,000. It's making you twice as much money as the mortgage costs for the same money that you would have plowed into paying off the mortgage, if this is making sense. So you can service the mortgage just using half of the interest you're earning on the money that you would have tied up by paying off the house. And there's only one way if you pay off the house, and that's to borrow it back out and prove there's a need why you should have it, and you must have the credit. Why not establish credit by taking and making the house payments and have liquidity, so if you need money, you can just withdraw it out of the insurance contract instead of having to borrow it out of your house when you do not have a credit history as a single person. Is this making sense? So be very careful about just going in and paying off everything thinking that's the smartest thing to do, because if you can be earning interest tax-free greater than servicing the payments on a debt that is tax deductible, you are beginning to understand how money really works, and you will have all kinds of flexibility. So let me reiterate what I would recommend to a widow rather than just paying off a mortgage. Let's say you have a $500,000 mortgage. If you got $1 million of life insurance proceeds from the death of your husband, a lot of times people, well-intending again, tell you, oh, well, just pay off that $500,000 mortgage. Well, a lot of people on a $500,000 mortgage, that interest rate might be at 3%, and it's still tax deductible if you do it right. So 3% is really a net cost of 2. So what's 2% on 500,000? 10 grand a year of interest, okay? Even if you borrow money at 4.5% tax deductible, it's a net cost of 3. So 3% is 15,000. Folks, if you preserved that $500,000 and put it into a Laser Fund, the Laser Fund has historically earned 6 to 10%. If you only earn 6% tax-free, how much more is 6 than 3? Double. You're earning $60,000 on $1 million, and you're paying a net of $30,000 on $1 million mortgage. We've been talking about a $500,000 mortgage. At 3%, you're paying $15,000, but you're earning $30,000 in your Laser Fund, where you put the $500,000 instead of paying off the mortgage. Is this making sense? You can peel off half of your interest and meet the mortgage payment. And you still have the liquidity. You can access the money anytime you want with an electronic funds transfer or a phone call. If you put it into a paid off house and you need that money, you don't have credit to borrow, you're going to have to prove you have the ability to borrow the money and the ability to repay the loan, or you're stuck. Do not destroy that opportunity to establish credit in your name, because most of the time in a Laser Fund, you're going to earn double and maybe triple what you need to continue to service the debt on a mortgage on a house. So rethink your thinking. Don't jump into something too soon. Learn how to become your own banker and earn rates of return greater than the cost of the funds, because banks and credit unions, their greatest asset is their liabilities. They would wither up and die if they stopped paying interest. It's not their foe. Paying interest is their friend, because they borrow money at a lower interest rate and they earn double or triple that or more by keeping it compounding, oftentimes tax-free, in insurance companies, just like I'm recommending you do. If this is making sense, I would strongly recommend you learn about the Laser Fund. Here's how you can claim your free copy of my most recent best-selling book, The Laser Fund. You go to laserfund.com, it's on the screen here, and claim your free copy. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will send out a book to you. There's also options there for you to listen and learn and watch and learn. But here's to your brighter future.